Hello and welcome, deep value seekers, to our analysis of Netflix Inc., trading under the ticker symbol NFLX. The current price as of April 19, 2026 is $97.31. Please note this video is for informational purposes only and is not financial advice. Netflix beat on revenue, crushed EPS by 55%, grew net income 83% year over year, and raised its free cash flow outlook to $12.5 billion for the year. The stock dropped 10% anyway. Why? Soft Q2 guidance, and a co-founder leaving the board. When the market panics over optics, while the underlying business compounds at this rate, that's historically where you want to be paying attention. Netflix printed $5.28 billion in net income for a single quarter, more than the prior two quarters combined. EPS came in at $1.23 against a Wall Street estimate of 79 cents. Free cash flow hit $5.09 billion in just 3 months. The stock dropped anyway, because Q2 guidance came in just $60 million below the street's estimate. That's a 0.5% guidance miss, triggering a 10% sell-off. That math doesn't add up. Netflix's ad business generated $1.5 billion in 2025 and is on track to double to $3 billion in 2026. Over 60% of all new signups in Q1 came from the ad-supported tier. The company now has 4,000 advertisers, up 70% year over year, and built its own in-house ad tech stack. Most investors still think of Netflix as a subscription company. The ad engine is quietly becoming a second business inside the first one. Management said it plainly. Netflix accounts for roughly 5% of TV view share globally, and as of end of 2025, it had penetrated less than 45% of its addressable market of broadband households. The total revenue opportunity they're targeting is $670 billion. With 325 million subscribers today and a $51 billion annual revenue run rate, Netflix is still in the early innings of its global share grab, and it's doing it while expanding margins and printing record free cash flow. Let's review the enterprise overview. Netflix started as a DVD rental service and reinvented itself into the defining entertainment platform of the internet era. Today it produces and distributes TV series, films, documentaries, live events, and games, all delivered on demand to any screen, anywhere. It's not just a streaming service anymore. It's increasingly a global media and advertising company. Netflix serves a remarkably broad consumer base, from students on the $8.99 ad-supported plan to households paying $26.99 for 4K premium. It operates in over 190 countries, with particularly strong growth in Asia Pacific and Latin America. The ad-supported tier has become the primary entry point for new users, especially in price-sensitive markets where growth headroom is largest. The core business is subscriptions, 3 tiers ranging from $8.99 to $26.99 per month in the US. But advertising is rapidly becoming a meaningful second revenue stream, targeting $3 billion in 2026 alone. Netflix also earns smaller amounts from licensing and gaming. The mix is shifting. Subscriptions still dominate, but advertising is where the incremental growth dollars are coming from. Key scale metrics include over 325 million subscribers, access to a $670 billion total addressable market, and operations in over 190 countries. The company is headquartered in Los Gatos, California, and was founded in 1997. Now let's look at the revenue streams breakdown, focusing on the company's segments. Streaming is currently the sole driver of revenue, representing 100% of revenue, with a year-over-year growth of 15.85%. An economic mode analysis shows that switching costs are low, at 2 out of 5. Netflix doesn't have the hardcore enterprise switching costs of a B2B software company, but it has something powerful in consumer terms: your watch history, your recommendations, your saved lists, your downloaded shows. The more you use Netflix, the better it gets at serving you, and starting over on a competitor means losing that personalized experience. Combined with must-watch original content, the friction to leave is real, even if it's not contractual. Network effects are rated 5 out of 5. Netflix benefits from a powerful indirect network effect. More subscribers generate more revenue, which funds more content, which attracts more subscribers. But the more interesting flywheel is data. Netflix processes billions of viewing signals daily, making its recommendation engine and content investment decisions smarter over time. No competitor can replicate 25+ years of behavioral data at this scale. Brand strength is also 5 out of 5. Netflix is one of the rare brands that became a verb. In nearly every country it operates in, Netflix is the default answer when someone says they want to watch something tonight. That brand recognition drives lower customer acquisition costs, commands pricing power across tiers, and gives the company a head start whenever it enters a new content category, whether that's live sports, gaming, or live events. Cost advantage is rated at 3 out of 5. Netflix spent $16.5 billion on content in 2025. That sounds expensive, and it is, but when you divide it across 325 million subscribers, the per-user content cost becomes very hard for anyone smaller to compete with. Disney+, Max, and Peacock simply can't afford to produce at this volume and quality. Netflix's scale means it can greenlight more bets, absorb more misses, and still have a deeper library than anyone else. Netflix owns the IP on an expanding library of global original content. Stranger Things, Squid Game, Wednesday, Bridgerton. These aren't licensed shows that can walk out the door. They're Netflix's assets, permanently. As this owned library grows, it becomes a self-reinforcing moat. Exclusive content drives subscriptions, subscriptions fund more originals, and the IP portfolio becomes increasingly valuable for licensing, gaming tie-ins, and merchandise. And for that, we give regulation an IP and 3 out of 5 rating. Moving to the DCF valuation assumptions, we're using a forward EPS of $24.42. We assume a conservative growth rate of 15% per annum. The analyst consensus forecast for EPS of 21.72% per annum. We are forecasting a modest share reduction of -1% per year in the diluted average of shares outstanding. This reflects our expectation for strategic share repurchases. A discount rate of 15% is applied, representing our required rate of return for this investment. We've applied a 30% margin of safety to the fair value estimate to account for potential risks and uncertainties. The exit PFCF multiple is set at 18, which is a long-run assumption for the terminal value. Finally, the projection period for our DCF model is a 10-year horizon. Now, let's look at the intrinsic value output based on our DCF analysis. The Wall Street mean target is $114.82. Our calculated fair value is $122.63. Applying a 30% margin of safety gives a target price of $85.84. Performing a reverse DCF, the implied growth rate the market is pricing in at the current price is 15.19% per year over a 10-year horizon, assuming a 15% discount rate. Our final verdict: Netflix appears slightly undervalued. Our fair value estimate of $122.63 suggests a 26% upside to the current market price. In summary, Netflix is a dominant streaming platform trading near 52-week lows after a sentiment-driven sell-off. Strong net income growth and an accelerating ad business present a compelling re-entry point. Thank you for watching. Remember, this video is for informational and entertainment purposes only, and not financial advice. Always conduct your own due diligence.